Hey guys, hope you are all having a great day today. For over a year, we have talked in great length about the housing market and its potential role in exacerbating the decline of the American economy. Hypothesizing from growing rents and mortgages to the homelessness crisis that is sweeping into every corner, and even going as far as to describe the scientifically backed data suggesting the correlation between home ownership and birth rates, there has been little that we haven't gone over. All the data presented to us by economic data suggested things were worsening constantly over time. Well, it seems like we reached the point where even managing to lower home prices is no longer a viable option for solving this problem. According to a new report by CBS News, surging mortgage rates aren't just raising the cost of purchasing a new home. An alarming number of recent homebuyers have discovered they already owe more on their property than it's worth. Some 250,000 people who took out a mortgage this year to buy a home are now underwater, meaning they owe more on their loan than the home is worth. Another million apparently have less than 10% equity, according to mortgage software provider Black Knight. Those unlucky homebuyers who clearly were not paying any attention to what is happening got caught in the crunch between historically high housing prices and rapidly rising mortgage rates. While the portion of underwater mortgages can still be considered low, at least by the means and measures of some very well-paid analysts who are clearly biased, a clear risk has emerged between mortgages homes purchased relatively recently versus those bought early in or before the pandemic. 8% of mortgages taken out this year are underwater, which is about 1 in 12 homes purchased. The jump in mortgage rates this year has played a part. Rates have more than doubled this year, as you are all very well aware of. Although it's not unusual for new homeowners to be underwater for a brief period, especially if they buy during the summer when prices are elevated, it is much more pronounced this year than it normally is because prices are starting to cool. The situation is much worse for homebuyers who purchased with government-backed mortgages, with 25% of those buyers this year now underwater, according to Black Knight's report. In places like Colorado and Honolulu, more than 30% of mortgaged homes bought this year are underwater. In Virginia Beach, about 22% are worth less than what is owed. California cities like Bakersfield, Riverside, San Diego and Stockton seem to be hovering around 20%. The funny thing is that it is not actually markets that are seeing prices come down the most, it's markets that are using more of this low down payment types of lending that seem to be the most affected, according to Black Knight's president Andy Walden. Things get even worse in this report. FHA mortgages, as well as mortgages backed by the Veterans Administration, typically allow home buyers to buy property with small down payments, sometimes as low as 3% for an FHA loan and none for a VA loan. That helps lower income purchaser who typically don't have much money saved for a down payment, but it becomes a liability when home prices fall rapidly, keeping people stuck in their homes, which is what has been happening. Unfortunately, the folk who first got hit when home values go down are those who couldn't put down a lot. I know this is a bit of a sideline content, but I swear that the United States makes it its mission to screw over veterans. When it comes to budget a marketing presentation to get people to enlist, the money and attention is always there. But when it comes to treating veterans with the benefits they are rightfully owed, the United States' government all of a sudden has so many blind spots and so little paid attention that it's as if they are working to screw over veterans. And yet they have the gall to complain about low recruitment enlistments not fitting the quotas and retention rates declining to all-time lows, but this is beside the point. Back to the housing market, one of the things you guys need to keep in mind is that being underwater actually becomes a bigger problem when homeowners have trouble paying their debt, which is beginning to rise and in my opinion will be the first big domino to fall to begin the worst of what this recession will have to offer. What we are seeing is borrowers who took out mortgages in 2022 becoming delinquent earlier. They are stretched a bit too much and we are seeing higher debt-to-income ratios. Both measures of distress are still historically low, but they are both on the rise. With mortgage rates likely to increase as the Fed continues hiking up interest rates, the concern is that more people will fall underwater. Black Knight's president expects things to get worse, and so do I. It is incredibly easy to underestimate this challenge. The housing crisis in America continues to be largely ignored by corporate media networks and even the general population. Everyone seems to be stuck talking about the dip in price valuation for crypto and the stock market, but nobody is talking about the other side of the coin, which is the housing market. Americans are literally going heavy into debt because they cannot pay for basic things. In fact, let's dive into this a little bit more because I feel it goes largely ignored as well. Consumer statistics show that the annual percentage rate for credit card rose to the highest rate since 1985. The national average, APR for credit cards has climbed by 2.74 percentage points so far this year. Industry experts predict shoppers will lean heavily on credit cards to pay for increasingly expensive gifts. The bad thing about this is that it sets us up for failure. A spike in layoffs will lead millions of Americans to begin defaulting. In these recent weeks, we have seen Facebook owner Meta slashing more than 11,000 jobs, Lyft cutting 700 jobs, Redfin annoying 900 layoffs. Amazon, Apple, Microsoft all followed suit, and to make things even worse, the pains of layoffs is spreading outside of the tech sector and growing into the financial sector now. The more people buy using credit, the higher the risk America faces with defaults on payments, and if layoffs continue to rise as seen now, expect a huge chain set of events that will erase stock valuations by the trillions of dollars in the coming year of 2023. And the most absurd reality of watching all this unfold comes from economists thinking inflation has peaked already, which is why we have witnessed the stock market rally in the recent weeks, even though this last week it began to deteriorate again. Wall Street seems to be obsessed with trying to get everyone on the same bandwagon of thinking and tries to convince everyone that from here on out, no matter how slow things are, everything can only go up because we already bottomed. Well, Main Street disagrees. What we have is an overwhelming sense of optimism based on relatively weak data points that are not convincing everybody anymore. Based on my own research, I predict that our recovery is going to be a very long one, maybe even a decade long. There will be optimistic years when everyone thinks we recovered, and then inflation will creep up out of nowhere and have us all going down again. It will be like that recession of the 1970s in many ways. People are overhyping a soft landing under the incorrect guise that rates will go down and people will get more loans and have more money to invest. But the thing is, we are not in a position where this is a viable path, and Jerome Powell knows this. This is why I always say the more we spike up, the harder we will fall. Everything moving up too quick will cause inflation to rise up, and the Fed will be forced to bring pains again, forcing everything back down. There will be a point where these perma-bulls' energy and optimism will go away, and the markets will not be as turbulent and volatile as they are because there will be no rush to buy anything. Even if you strongly believe that inflation peaked, it doesn't mean it went away. It just means that it has slowed down. 8% inflation next year instead of say 10% inflation is better, but it is still really bad. The thing with inflation is that if you don't drop it quickly enough, it begins to eat into people's savings and buying power. And with America's record-setting credit usage, more and more people will begin defaulting on payments, not only for all the worthless Gucci bags they bought, but on housing as well, which is what Black Knight reported as seeing a trending growth in. Guys, nobody is saying it, but we are in the beginning stages of what could potentially be an exhaustingly bad economic time period. I am not trying to be overly negative, but the numbers don't lie, and simply put, there isn't too much data suggesting things are improving long-term wise. This upcoming week we have the CPI report for the month of November, which will have huge ramifications going forward. If numbers are higher than expected, there is a high chance that the whole market will wipe off trillions of dollars in the coming weeks. If it comes as expected or below expectations, the market could make a huge rally above $400 on SPY alone. I am leaning towards inflation measures cooling off a bit further for November, but I still believe that the number will remain high. The Producer Price Index, which measures prices paid for goods and services by businesses, rose 7.4% in November compared to a year earlier. That's down from the revised 8.1% gain reported in October. Stocks fell because investors expected wholesale prices to have risen just 7.2% annually. Higher than expected inflation readings raised concerns about whether the Fed can tame inflation. Again, it's a 50-50 in this situation, so my opinion has as much probability of being right than being wrong. Either way, I am bearish for the longer-term reading for the economy. One last important thing to wrap things up today, and this one has to do with housing and birth rates. A new blasting report by The Economist shows that Asia's advanced economies now have lower birth rates than Japan. This is huge, because Japan has been the poster child for having the lowest birth rates in the world. Most of Asia is now either caught up with them or have overtaken it. Japan's fertility rate of 1.3 in 2020 puts it on par with mainland China. China's birth rate is likely already to have fallen behind Japan's. Chinese births last year were 10.6 million, down from 12 million in 2020, a decline of 11%. The number of births fell only 3% in Japan. This is a huge problem that the world economies don't know how to tackle. One side, they demand workers work harder, longer for less pay, less benefits and less life fulfillment. On the other hand, this is causing people to become extremely stressed, depressed, unfulfilled and not able to go out and mingle. It is very easy to underestimate this problem, and I often hear people saying immigration is a great way to solve it, but I disagree. Canada has a huge mass immigration program with very generous social systems placed, including universal childcare, and yet they still face massive labor shortages. The biggest issue is that baby boomers are leaving the workforce in droves and leaving behind a huge gap in labor shortage that cannot be substituted. Furthermore, America, Europe, Canada and many Asian nations also have overeducated immigrants who are still stuck in menial jobs, and even still, there is a shortage in the trades jobs. The real answer to this problem will force the entire globe to change its approach to economic systems. As of right now, the written rule is that everything must grow, but that is years to come from now. As of this very moment, you have highly competitive societies that all seem to share a variety of drawbacks that are making it difficult for younger people to want to have kids. First, the unattainable costs of housing. Then add daily life to that. I know I am not the only one that has noticed how going out on a Friday night with my friends can lead to hundreds of dollars in expense when not too long ago, you wouldn't even spend $100 having fun. Add to that long work hours, with bosses demanding overtime for little worthless compensation under the guise and lies of promotions and career growth. There are too many cultural flaws that make pragmatic and reasonable concessions to happen that would allow society to find solutions to the challenges of today. I don't think having more people will be a solution to the world's biggest problems. Automation is right around the corner, and in the vast future, we will all live off of welfare for the most part, since most jobs will be replaced. Driving, manufacturing, financial jobs like accounting for example, and even teaching will mostly be automated at some point in our lifetimes. Imagine what 100 extra years will do to that. There has also been a change in desires in newer generations. Life fulfillment isn't met with just pumping out kids. People want to travel, to see and experience the world, to do things that are vastly different from that which was normal and expected 50 years ago, and that is going to lead the world to have to face the questions of what it is to have a functional economy. It will not always be about growth as it is now, and we are slowly coming to that realization. It's just going to be extremely painful getting to the point of doing something, as big corporations will try to fight this with all they have to protect their assets and worth. But I am more curious as to what you guys think of this. Let me know in the comments below your opinions on life, fulfillment, decreased birth rates and what it could mean for us all. Thank you for watching this video. I have already begun working on the next segment, which should be out sometime either on Wednesday, Thursday or Friday. Join my Discord for more content and to the moon.